Welcome back to the Journey to Financial Freedom. I'm your host, Dr. Johnny with Anachi, aka Dr. Johnny Walker. We have a special guest here today, and I'm going to jump right into what we're talking about, which is the Pave. Now, if you've been following us, you know we've had a flurry of activity. We've done 3 separate deals: an oil and gas deal, which was closed, overcommitted. Our apartment building deal with Rise 48 closed. And the self-storage deal also closed. So very successful, executed on the acquisitions of these properties. Last but not least, this is our last deal for the year. I know we were going to try to put together one more oil and gas deal before the end of the year, but that deal fell through. We don't want to overpay for anything, so we just stuck to our guns and we stuck to our criteria and we passed on a deal. But now, what that means is, hey, look, we're not looking to do one more deal in December. But now, when I say the last but not least, this is our private equity deal. And I haven't been focused on presenting a lot of content on it, not because it's a lower priority, but only because the other deals had more pressing timelines. Well, the timelines are starting to get a little pressing for this deal also. And we're going to be actually closing on the next business. But I'm not going to get into that detail because we're going to go into it right now. We have one of the key principles of this private equity deal, which is the Pave. And it's a very, very exciting deal, right? We wouldn't bring it to the table here and bring it and offer it to our community if we weren't very excited about the deal. Well, you already probably know that by the post that we've made, but there's been progression in the business plan, right? Things are starting to move and they're slowly starting to, the team is starting to knock down dominoes and the freight train is starting to gain momentum here. And that's why I'm very excited about it. I want to express that here. People that have already invested, they can ask questions here as whatever they need. If there's people that have kind of looked at this deal but haven't committed because they maybe just have some questions, maybe have some hesitations, this is a perfect opportunity for you to bring those up. You could let us know in the comments below. If you don't want to do it in the comments, DM me. More than happy to discuss this. But without further ado, I want to bring back to the show a good friend of mine, Mr. Sam Silverman of Silverman Capital. And he is one of the founders of principals of this venture.
Yeah, Johnny, thanks for having me on. I know it's always a really good turnout for you in terms of the group you put together, and really cool in terms of different types of deals that you're working. And I thoroughly believe in the diversification that you guys are bringing, and happy to kind of dive deeper as it relates to the Pave and answer any questions that you and the listeners may have.
Sure, sounds good. Now, anyone that's following, we've done nothing but real estate deals up until about 6 weeks ago. But we've started looking at other types of asset classes because getting diversification, you're not tied to the cyclicality of any one asset class, right? Like, for example, if we do a lot of multifamily, but we're late in the multifamily game and the cycle, harder to get properties to cash flow, harder to get properties to paper at current market conditions. Now, this has led us to look at other avenues as well. And, private equity is an excellent one because the rates of return, the rates of cash on cash, especially with this deal, are a lot higher, right? But at the same time, we want to mitigate risk as well. We don't want to just, be chasing returns. But we're going to explain why this deal kind of, especially for the type of deal that it is, really goes a long way to mitigate risk. But, before we go into those minutiae, let's at a high level synopsis. What is the Pave about? Sure. Again, right? And what are we trying to achieve?
Yeah, so if you look at what the Pave is focused on achieving, the industry of paving itself is very fragmented. And what that means is that there are a lot of these smaller companies, right? We can view companies in, 2 bigger buckets, right? Maybe even 3. That first bucket being these super small mom and pop paving shops that are doing, $1 million, $2 million a year of revenue, right? There are very few of those. So you have certain buyers looking to go take companies down like that. Additionally, you have super large publicly traded companies like Construction Partners, Inc., right? That have $100 million plus in EBITDA. They are very, very large, right? And then you have the sweet spot that we're playing in. And when you look at that sweet spot, we're buying companies between $1 and $10 million of EBITDA. And what you're seeing is that these companies are going to trade at a multiple between 3 and 5x, meaning if they have $1 million of EBITDA, we'll likely pay between $3 and $5 million in total. But when you get to that about that $10 million mark in that portfolio or company size, you're seeing those multiples go 10 plus, right? So what you're seeing is that these larger private equity, institutional, mid-market family office type groups are very okay paying a very nice premium to a group like ours that can go in, aggregate these fragmented mom and pop type companies that have been around for 20 plus years. So if you look at a typical company that we're buying, the first company we closed on back in September is a great example. So the owner, his name is Dan. He is 68 years old. He works 2.5 days a week at most, and he mostly is in his mountain house. He's run the company successfully for 25 plus years, right? They've been consistent for him. They've been great. They've been producing about $1.5 million to $2 million a year of cash flow for him personally, right? He can go run his whole life at the company. It's been a great business for him. There's no need for him to try and go take that company from $1.5 million a year of profit to say 5. Because what Dan thinks is, my life's gonna get a lot more stressful. So on our end, we want to help someone like Dan who has no clear succession plan, right? We want to go take our expertise in terms of bringing the right people, the right marketing, the right systems. For example, Dan's company didn't even have a website in terms of driving new business because they didn't want more customers. So what we see is an opportunity for a great stable company to go bring in a level of expertise on our end in terms of systems, marketing, accounting, to make that company grow, operate more efficiently, etc. We're trying to go acquire a handful of companies that are similar in structure to that and go roll them all together under one portfolio called the Pave.
Very cool. So now if I got this right, we're basically looking at, hey, look, let's acquire 5 to 8 properties that earn between 1 and 10 million. We're going to pay a fair price. But now we're looking at, hey, look, let's kind of aggregate this into one brand, one company, right? So integrate the back end. So it essentially is one company and sort of deliver that in a silver platter to a larger buyer. Was that sort of accurate in how we're summing it up?
Yeah, and we're not going in and gutting the whole team. We're not going in and changing everything because what we're seeing is that these companies are successful, right? This has been a company that's been 20 years plus of history of producing 7 figures of income for the owner, right? So it's been a very, very solid company. On our end, we're going in and tweaking very small things. For example, we're going in and bringing in new accounting systems, right? So we can go have better visibility into the data, make better decisions off of, right? We're reducing costs in certain roles, right? We're bringing in certain levels of technology and automation to help the team adapt to the growth behind it. Also, what I can tell you too is like even things like, hey, we're not making an effort to go bring a new business. We've signed $6 million of business in the last 6 weeks in this company, right?
This is Dan's company or the...
Correct. Yep. D&O Contractor is our first company that we closed. We actually recently promoted his daughter, who worked in the company her entire life. All the vendors know her, all the employees love her, right? All of their clients know and like her. So it was a great move on our end in terms of bringing her in to help lead the company. And since then, she's sold $6 million in new business in the last 6 weeks, which is huge. So now by putting that focus on driving new business, modernizing their systems, right? We're really seeing that we can actually help grow these companies. And to be clear too, in our model, we're not saying we're going to take a company that's doing $12 million a year, like D&O, and make it do 30. That's not in our model. Our model really is to go help clean up small things in the back end and go build a portfolio that has a level of synergy. So for example, what D&O does really well, they do ground grading and earthwork, right? There's also site prep that goes into it. There's actually a paving work as well, and then maintenance. We're trying to buy companies that have different pieces of that puzzle to go together, right? So that way when D&O has a job that requires maintenance, instead of giving it to a different partner, we can give it to one of our portfolio companies instead. So in turn, we're growing the business organically by things like that. I think what we'll see is we'll grow overall as well, but we can just grow through synergy and back-end cleanup more than anything else as well.
So you're saying that there's not necessarily a need to, hey, we don't need to go and make this company, drive this company to have, ridiculous amounts of increases. It's like, hey, look, we can just kind of clean this up an already existing business and even operate as is. If the NOI doesn't change, it fits our model, right? Is that correct?
Correct. Yeah. So part of our end is we're growing through acquisition, and in turn, you're creating synergy both on the expense flywheel, right? The more we acquire, our expenses should go down in certain areas. And also, the more we acquire in terms of how those companies fit together, our revenue in aggregate should go up because they can go feed each other, right? Like on your end, right? Say, and I may push this example too for your dentist folks, right? You may have a dentist that now acquires an orthodontist branch, right? They can go feed them all of their clients for braces, right? We want to do something similar on our end. All the companies we acquire, if one of them gets a new customer or has to go service customer in a certain way, that should go feed the remaining companies in terms of new business we're getting as well.
Got it. Now, all right. So I kind of understand what we're looking at, right? We want to try to acquire about 5 businesses in this range. We can kind of help put it together in terms of the systems, not trying to change how they're doing it, not trying to change their key personnel, especially if it's working, but put them in a position that they can kind of succeed, right? And do what they have to do. And now we're introducing systems, procedures and ways to do things, create efficiencies through economies of scale, right? Whether you have multiple practice, if you're grouping together multiple dental practices in a same town or city, it's the same type of synergy that's created, right? Like, hey, one assistant calls out, well, no, we can borrow an assistant from the other office, in an office that's not as busy. You can share these resources instead of going and hiring, expensive temp agencies and stuff like that, right? So I think we're familiar with that, sharing expenses amongst several offices or several practices. This is sharing equipment. This is sharing expensive equipment. Instead of buying expensive equipment item for every single practice, we might buy 2 or 3 of those machines and share it amongst offices that are located geographically close together, right? So I'm assuming this is similar to what you're talking about here. Now, in order for that to happen, I would assume that these kind of companies need to be located close together, right? Like, where are we looking at acquiring these businesses? Or is it all over the country?
Yeah, so what we found in conversations with larger private equity firms, something we're doing as well is we're trying to go engineer the exit, right? We're having conversations every month at least with potential end buyers for portfolios like this, right? Because we want to go build something that they want. So getting their insight and input over that time period has been super helpful as well. So at our end, we're focused in the Southwest. So our first company we acquired was in Phoenix. Our second company we're acquiring this week is in Utah, right, which borders Arizona. And the really cool thing with the second company is that they're built on the practice of sending their crews to different locations. So for example, in Utah in the winter, you have snow for 3 months. Those crews can easily go to the surrounding markets to go work for stints of time as well, make sure they're being utilized really efficiently. But what we're seeing as well as other companies, for example, Construction Partners Inc., is that they're nationwide in where they have companies. So we see it as our likely end buyer is going to be someone who has locations across the United States. So yes, we want to have the geographic focus on our end, but from the conversations we've had, we wouldn't be penalized if we go dip out of that area as well.
Got it. So that's a compelling statement right there, right? Like, so you're already talking with people that are looking to buy this type of thing. And I think that's an excellent way to create, to iteratively make the product that you're offering to these end buyers better, right? And more suited to what they're looking for. It's not like, hey, let's build something and hope that this is what the market wants. You're getting feedback from potential buyers by, constantly talking to them every week. And now you're building this company that you're getting market feedback from sellers, right? I think that's an important fact to highlight as well. And I know we kind of about that offline a little bit. No, go ahead. You want to say something?
And it's something too. So if you look at our advisor, Sean Godwin, he runs a almost $400 million a year paving firm in South Carolina. So something we really helped do was just fill the team with experts in the paving sector, right? In terms of bringing those folks who have been there, right, grown organically, grown through acquisitions, in terms of taking over companies, right? Because the big thing that you have to be cognizant of is when you go buy a firm, right, you're taking on their employees to make sure that transition goes really well. So we're working with people who have been there and done that and can really help the team show that, hey, our goal is to make this more profitable, make the work experience better, right? So really kind of pulling all those people in the same direction, right? We're kind of looking at the overall business plan itself together too. So we feel really confident about the team itself of paving experts we put around us as the operating team. Another big thing too is that when we're talking to these sellers, right? This isn't real estate. Real estate, for anyone who's owned it, it's not as emotional, right? Like you own a property, it's usually viewed as a number on your balance sheet, right? You view it as a debt, a liability, or an asset, which is usually some combination of all three. And when you look at buying a company from someone who has built this from the ground up for 25, 30 years, it's a lot more of an emotional play, right? So we're working with sellers very, very closely, and the feedback we're getting is that we're really approachable with them, right? Typically, you're seeing the private equity folks who view them as a number on a spreadsheet. I think we've really been able to go connect well with potential sellers off market, because getting someone to go sell their company for 3 times their yearly profit is tough, because for them, the alternative is saying, hey, I can go hang on for 3 more years and I'm good, right? I've already made that money back instead. So for us, being able to go connect with these sellers, work with them, right, have a great transition plan, and carry on their name in a strong way, has hit home in terms of helping us go acquire companies off market and build great relationships there too.
Nice. I mean, so we're focused in Arizona, Utah. We're talking to end buyers, creating good relationships with these smaller operators, the mom and pop operators, as you say, that have ran successful businesses. We're integrating now. Who are the people that are going to be, creating these systems and integrating this? Who has the specific skill sets within your sponsorship team to be able to do this? Okay, so the idea sounds great, but
sure.
And you mentioned an advisor that's come on to the GP as well, right? Sean Godwin, who has a $400 million paving company, huge level of experience there. Obviously, can only add to this process. Now, the actual process of rolling up companies, where is that expertise? Who has that skill set? And why? And is this a viable business plan based on the skill sets of the sponsorship team?
Yeah, so if you look at another one of our advisors, Rob Levin, he's helped taken 3 companies to go public as well, right? And for him, he's helping us a ton in terms of packaging up the offering itself, right? In terms of how to go build this. There's also, when looking at it, in terms of actually implementing the systems and process, Sean has acquired 6 companies on his end into Palmetto Corp as he's grown, right? So we can go leverage his staff as well, right? His HR, right? His process and SOPs for doing so. He also helps us in the deal review stage too, right? When we have a deal under LOI, he helps us go thoroughly vet it when looking at, does this deal make sense? How do you integrate this? What systems do you bring into play? And there are simple things too, like bringing in in-house accounting, right? Bringing in in-house marketing, bringing in in-house legal, right? All small things people don't think about at times make a huge difference when doing so.
Sure, yeah. I mean, yeah, that expertise, rather than trying to figure it out through the school of hard knocks, having this people that can guide you, point out major errors or maybe minor errors that cumulatively, add up into that affect the bottom line. So I can see all the benefits of that. Now, this plan sounds good. Now, what are the risks, right? What are the risks? What are the chances of me losing my money in this deal? And my reference point, as majority of the people that are, invested with us, they are comparing it to, say, for example, multifamily real estate. How would you compare and contrast the risks and then, as well as the returns? Where are the risks in this business? What should we be worried about as an investor?
Sure. So one big risk itself is the deal structure. And I can walk you through how we mitigated that as well. So for example, the first company we acquired, D&O Contractors, we're buying them for $6.5 million. In that structure, we give them $2 million of cash day one. They carry a $1.5 million seller carry for 5 years. So in turn, they're getting $3.5 million effectively at closing. To earn the remaining $3 million, the seller has to perform and hit a certain EBITDA threshold over the foreseeable future. So for them, the transition plan, I think about like that's their retirement. With getting $3.5 million and $6.5 million for retirement is a very big swing. So in turn, we have a lot of hooks in the sellers themselves where the incentives are very aligned for them to perform, right? That's number one. I think the second company we're acquiring too, right? We're putting $2 million of equity into this company as well. We also have first right to go liquidate their assets in the case it doesn't perform. They have $3.5 million of equipment, and we have first liquidation rights in doing so. Right? There's a lot of heavy machinery.
$2 million in. Investors are only $2 million in, and there's $3.5 million of just equipment.
Correct.
And this is first in line. We're as the investors, we're first in line for this.
Correct. So we view that as a way of mitigating downside risk in a massive way. The reason we structured it that way is that this second company landed a massive contract. They landed a $10 million contract for materials. And what that means is that that contract actually starts in about a week, right? And that's a huge, huge upside. So we structured it where the seller can earn more if that contract performs in the long term. So we helped share the upside with them. Then in turn, they helped cover our downside in the structure itself. So the owners themselves, they wanted to go be done, right? They view this contract as they think this $10 million piece of business for materials that are local to their area is just the tip of the spear in terms of their ability to go grow that relationship longer term. And that actually operates at a far higher margin than typical paving business as well. So the company itself, this contract aside, is a great company to go buy purely in their paving business. We view the material side of the contract as a massive upside in which they've covered all of our downside on in the structure itself. So I would say the structure of deals is a huge way we protect ourselves and investors in doing so, but by giving minimal cash up front and having a lot of mutually aligned incentives in terms of earnout structures where they have to deliver, they have to transition the company in a meaningful way, and that's they earn that remaining piece of the pie.
Additionally, I love that. Oh yeah, go ahead.
Yeah, additionally, when you look at the alignment, right? Like to go back to the first company, D&O Contractors, the owner's daughter is helping take over as the CEO. Even if we have a year, 2 years on Dan staying on, helping support us, if she's the CEO, if she texts him, he's going to answer. There's a massive amount of family pride. Her name is on the wall, right? Their last name is the O, right? So for them, there's a huge amount of family pride and legacy they want to go help carry on. So for him, even if he's only contracted for 12 to 18 months, she'll have access to him and all the institutional knowledge he has likely forever. They have a very strong relationship, very strong family bond. So we really viewed, giving her a platform in the company as a massive way to help us keep that bond. And she's qualified for the role outside of that. This is something we felt gave us a lot of upside and potential there too.
Yeah, so that sounds like, that sounds very favorable in terms of risk mitigation. I mean, number one, the amount of cash going in often is less than the invested cash is often less than just the equipment alone, right? Hey, look, if for some reason this business went to zero, we could still sell off all this equipment and get our money back, right? That's compelling. Number two, you're saying the structure itself. Hey, we're giving you a portion of the capital up front. We're not writing you a huge check up front, but instead we're giving you a portion of the amount that you're going, and the rest is earned by incentivizing them. Like, hey, look, the more profitable you can make this business, the more money that we can pay you on the exit, right? So so that makes a lot of sense to me. The keeping on the people that have already made this business successful, know how it's running, know what to do, as well as having access to people that know what to do. Those are all great, knowledge-based advantages, for lack of a better word, that we have. Now, you said these guys stay on for the foreseeable future. How long would the seller be still involved before they say, hey, look, now I want my money and I want out? I mean, typically in this structure, how long are they staying on? Like in the dental world, you might have a ductist that needs to stay on for 5 years, right, before they can sell. Like a lot of times, if you sell to to a large buyer like a DSO or a private equity firm that already has 175 offices, they're very specific. Like, hey, look, we'll pay you 8 times EBITDA what your earnings are in this practice, but you have to stay on for 5 years. We're only going to give you a certain amount of money up front, and then we'll pay you out after each year, right? Like, so what is the typical timeline for somebody in the paving industry?
Yeah, so our first company we're acquiring, he's staying on for 12 to 18 months. The second company, the owners are likely going to stay on for up to 5 years. And for us, we view that as a huge win because there's someone we actually looked at to go hire in the case that we were going to buy their entire company. So for them, they're staying on for a long period of time, right? They're people that we're super excited about in terms of their competency and their ability to go help in the company, right? And for them, they really needed the operational support on our end that we can go help with them to deliver that materials contract. Because they view that materials contract that's $10 million today could quickly grow far larger, and they want support making sure it doesn't get out of hand. So we view it as they get to keep a bigger piece of the upside, and we have the rights to the remaining part of the company going forward, where we have the rights to go buy the remaining piece of the company at a 17.5% discount. So for example, if this company is now worth $100 million, we would get a $17.5 million discount to buy the remaining piece of the equity in the company itself. So we have the warrants to go do so. So it allows us to go cover our downside massively, right? And if this contract performs, the seller also gets to have part of the upside as well. And we get a sizable discount to market itself for only putting $2 million of equity in. So for example, this company ends up failing entirely, right? This contract itself, we would then have the option of liquidating, right, to get our capital back out, or we would have the option of just effectively buying the paving piece of the business for a sub 4x valuation, which is right in line with where we see the market itself. If this company ends up being a complete home run and say they're worth $100 million in the future, we eventually have $17.5 million of profit on a $2 million investment in that chunk. So we view it as we have massive upside, and we feel very confident that our downside is covered there as well.
Yeah, I mean that sounds like a lot of ways to cover the downside. Having a small amount of money control a large amount of sounds like there's an extreme amount of leverage there. In a very positive way, especially for the investor in terms of protecting investor downside. So,
and to answer your question further too about the risk and kind of how it compares as well, where you always have more operational risk, right, in buying companies. And the reason is that in multifamily
versus multifamily, right? Like,
multifamily, like when you look at buying an asset, you've got a handful of things you can go do, right? You can go put in new washer and dryers, you can go change the kitchen out, the floors, right? You can go fix the pool up, add some amenities. But in turn, you're really capped out at what the market itself will support. So for example, if the area that you're in supports $1,200 of rent, and you make that property as nice as possible, you're likely only going to get $1,200 of rent. On our end, we have all these different levers we can go pull in terms of systems, people, marketing campaigns, right? Collaboration with other portfolio companies. We can go out to go to RFPs, right? For example, bring the new CEO in on our end she's a woman, right? So you get a big opportunity for minority-owned businesses or women-owned businesses as well, right? So for her, the ability to go pull in new contracts where they have to give a portion of it to WVE, right? Women-owned enterprises. So we see a huge opportunity there too. But again, there's more operational things that you have variability in. Also look at the valuation of it too. Buying multifamily property in say Dallas right now, you're probably paying 18x, 19x in terms of your NOI, right? When looking at the valuation. We're buying companies for 3 to 5x. We have a lot more room in those numbers to, have positive leverage when looking at something like your debt, right? Or having more cash flow going forward because of that. So we feel very confident in it because of those reasons. And we brought in people as well who have been there and done that in larger companies and have that skill set who can go really help us see ahead in terms of what we're going to go face, help us go mitigate risk instances as well.
So, And then, in terms of the risk, you said that. Okay, you know what? You answered. I think you answered my question there, right? Like, so I think we've talked about risk pretty well. It's answered a lot of the questions I've had. Makes it feel a lot better about it too. But you did say that risk is higher you said that there's also a lot more. You flip that into the positive that, hey, there's a lot more levers that we can pull to make a business grow, right? Whereas in multifamily or real estate, for certain types of real estate, it's much more limited. But at the same time, this also adds a higher risk, doesn't it? Like when you have more moving parts, like buying a business versus real estate, the flip side of that, of having multiple levers, is that, hey, look, it takes somebody, strong operator, that can control all those levers and know what each of those levers do and how much to pull, how much to push one lever, right? And turn a knob, fine tuning different parts of the business. I'm assuming that's where the higher risk comes in relative to a real estate deal, or perceived risk.
Yeah, it does. And what I'd say is that in our eyes, you're being compensated in a massive way in terms of returns versus the additional operational levers you have to go pull and manage, right? Also keep in mind too, these are companies that have been profitable for 20 years, right? Like they've been humming along for decades in terms of profitability, and it's been a great lifestyle business for a lot of these owners. So for us, we view it as all opportunity, and they're doing a lot of things right so far. There's not a ton we're going to go in and change. Of course, there are things we're going to go tweak. Of course, there are things we're going to implement over time, but we're not trying to go buy something and shake up what's working. We want to go make a few small changes that have a huge impact overall, right? And we're doing it from a place of strength that they've been performing well for decades at this point too.
Wow. Yeah. I mean, that makes. And the other thing you said is a lot of these guys, they're not trying to push the business, right? They're not marketing, they're not advertising. They're like, hey, look, I don't need to take on a whole bunch of new business. I'm making $2 million a year, and I'm very comfortable with that, right? But it's like, hey, look, now you just all of a sudden have a website, maybe do some SEO, and all of a sudden, the contracts grow very quickly, right? Maybe you do some marketing.
Think about it too, think about if you're from, say this was you, like you're working 2 days a week, making $1.7 million a year, and you have a great life, right? Like you may see it as, if I want to go from 1.7 to 5, right? That's going to be a lot more work. And there are going to be, just a lot more things you have to go do. There's no incentive for you to go drive the business in that way.
Yeah. No, I mean that you see the same thing happen in the dental world as well. You'll see a practice owner that's well established. He's had a dental practice for 20 years. He's got $6 million of revenue. He's not pushing the business anymore, right? He's there half the time. He spends half the time in Florida. He's letting his office managers and CEO run the company. But the guy, the leader that's there pushing the business, growing it, he's taking it easy now, right? Like he's taking a step back a little bit. And he's sort of earned the right because he's built this incredible business that supports this incredible lifestyle that they have, because they just make a lot of money, but they're just not incentivized to even make small changes to potentially greatly improve the business, right?
And it's small things too, right? Like these are typically pretty blue collar folks who own these companies. And I don't say that as a dig at them in any way. Like they've put decades and decades into building an awesome lifestyle from the ground up in doing so. And for them, there may not be the level of sophistication they have to go put in systems. Like the simplest term, they didn't have a website. They're doing $12 million a year of revenue with no website, right? Like things like that are crazy to think about it, of just these little small tweaks that we can help them make that make a massive difference. And again, it's say in multifamily, you're always hitting this, hey, this deal was bought off market, we found it off market. What discount are you really getting? On our end, we're getting 2.5 times discounts, right? Where if a company has $10 million on market in terms of EBITDA, that should trade for 10x plus. We're getting these companies, and granted they're smaller, we can go piece together and build a really nice portfolio of it at really good values that these larger groups just don't care to go do, because they have to go deploy a bigger check. So in turn, they're just paying this premium to a group like ours who will go do that legwork for doing so.
So this is like a $10 million, even the company that we're saying is a small company at 10 million EBITDA, at 3 or 4 times EBITDA, if you're paying them 3 or 4 times 10 million, I mean, they're still getting a sizable amount of money, right? They're getting 30, 40 million dollars for that business.
So once you hit that $10 million mark, you're more closer to a 10x. The companies we're buying are, historically 1 to 5, give or take. We're looking up to 10 million, but we're only paying between 3 and 5x. I think a really important thing here too is that in our underwriting, the biggest lever we can go pull, right? We are modeling 2 big things that are really important for listeners. 1, our expenses will grow quicker than our revenue. So we're modeling for our expenses to go up each year at a quicker rate than our revenue is going up. So that's one big area. 2 is we're modeling a 4.5x multiple on the exit rather than a 10x. And the reason we did that is that we want to be as conservative as possible, right? The groups we've talked to who are potential buyers in the future, they're looking at this and saying that we were way, way, way too low when looking at how we modeled the exit. And the reason we did that is that we'd rather show investors, hey, this is our model, this is a huge level of conservativity, and we feel as though we have upside, right? We wanted to make this look more similar to a real estate type deal, right? In terms of the numbers that it shows. The numbers, if we kind of shift them and actually put in an 8x or a 10x, they jump substantially. So we want to be really conservative as to what we showed to make it honestly more believable for folks who are like getting more familiar with this space as well. Like my background too is similar. Like I came from real estate as well. And I really just view this as a huge shift in focus as there's more opportunity here when looking at this space right now.
Yeah, I mean, hey, look, we get excited. We're like we let's say we see a real estate deal that has a 1.9, equity multiple, and then we see another one that has 2.2. Like, wow, these guys have a much higher, rate of return. But when you're looking at the rates of return on these deals, these private equity, it's very, very compelling in terms of rates of return. I mean, so. I'm just bringing up this slide here. This is up in our fund, our Walk of Wealth fund. This deal is actually up for those that are interested. I mean, this is what we're kind of looking at, and let's compare and contrast this, with a real multifamily real estate deal.
Sure.
Now, we have a 50K minimum. We actually have a 25K minimum for our mastermind community members. Typically, we do 50K to 100K minimums on the multifamily, right? So we're looking at typically we're having a lower entry point on this deal versus a multifamily. The hold time, very similar to a multifamily deal as well, right? 4 to 7 years. But now the goal of the Pave is to acquire these 5, 6 or 7 or 8 paving companies in the span of over the next 2 years, basically, right? And then operate them for several years. Or
we think based on the pipeline that we have, we can close this very, very, very high likelihood in 2025, potentially as soon as Q2 of 2025 as well in terms of our acquisition pipeline. And the kind of modeling that we have, that would get us about $15 million in EBITDA across the portfolio itself for the companies we have kind of lined up that we're looking at right now.
So now, if you can acquire them so quickly, why is the timeline, 4 to 7 years versus say, 3 to 4 years or 3 to 5 years?
So we want to give ourselves ample time, right, to go disposition this. On our end, if we can go acquire companies as quickly as we believe we can, what we don't want to go do is put a really tight timeline on it and be forced to go rush to buy companies that aren't quality. Right? The more companies we acquire, the more specific is what we're looking for in the next company, right? Like I was mentioning earlier, if we have a company that focuses on earthwork and site prep and paving, we need a maintenance company to go in there, right? You're trying to find pieces of that puzzle that fit, and the less pieces of that puzzle fits, the later you get in that cycle. So for us, we don't want to be forced to go deploy capital into bad companies. We want to give ourselves that runway. But on our end, if we get, offers in year 2, year 3, year 4 that make financial sense, it's not as if we won't consider them,
Right.
Because this model is the cash flow we believe has a lot of upside, but we also look at this too as this is primarily an exit-driven model as well. That multiple on the end, right? If we can get to $15 million EBITDA and trade for 10x, that's a massive windfall for everyone involved too, right? So really important to go think about that as well. We're going to look at the potential exit of it.
So now that exit though, that could come a lot sooner than 7 years. I mean, there's ample time. You're saying is, hey, we want to make sure we're buying the right businesses. But let's say, hey, we got a robust pipeline. We identify, we find properties that are or businesses that are fit our model perfectly. And if we're done, finish, say even by the end, you said Q2 2025, we maybe have all these properties. Maybe what if, like we say, by the end of next year, we've already closed on these 5 businesses. How much longer do you have to wait to get that 10x? So somebody to offer 10x, you have to run it for 24 months to prove it. I mean,
yeah, they typically want to see about between 18 and 24 months of stabilization, right? In terms of a consistent performance when looking at the history of it. So again, we're having these conversations early on with potential end buyers, right? To help go craft the portfolio, the system to process around what is it they want, right? So we're getting feedback from the market really quickly as to how to go build something that aligns to this. So on our end, again, if like we believe we have an opportunity to go sell sooner, right? If things go well, and it's something that if the numbers make sense, we will gladly go, move on from the portfolio itself. And
yeah, well, that makes a lot of sense. So again, these numbers are conservative.
The next slide.
What's that?
You want to hit the slide? I think 18 below.
Sure.
I think that's got. Yeah.
Oh, okay. Yeah. So I mean, this makes. I just laugh because I'm like, look, when I'm just looking to compare this to like multifamily, right? Like, so this is projected investment. The 4.5 EBITDA multiple on exit versus the projected performance of 5x equity multiple. What are the difference between these two numbers here?
The 5x multiple is the investor level projection.
Right.
So where your modeling is $1 in to $1 out, or sorry, $1 in to potentially $5 out over the whole period.
Right.
The 4.5 multiple is saying that if we have $10 million EBITDA, we're modeling that'll sell for $45 million. When historically, and I can send you some data on this too, that's traded for 10x plus.
I've seen, I was looking at, and there is a form, and I'm going to share it in our investor portal so people that are interested can see it. But they're not the first ones to do this roll-up strategy with paving companies. In fact, it's been done many times, and they have a list of how much these guys are, what multiple of EBITDA these are trading at. And I've seen a lot of 10s, I've seen some 12s, but there was a lot, I would say, between 9 and 12x. This is modeled at 5.
Yeah, at 4.5. So basically, in real estate, it's like the same example is that 6 cap deal on the exit, make it a 12. Right? So you're basically cutting your multiple in half, which we view as a massive level of being conservative.
Right. So now the big play with this deal is on the exit. Right? Just like in a multifamily deal, right? In multifamily, you're going to get a small amount of cash flow, small amount of cash flow. When the deal is sold or refinanced, this is when you're going to get a return of your capital, or at least a portion of it if it's a refinance, and potentially a portion of your profit as well. So when there's a liquidation event is really when you make your money. This is the same with this deal also, except from an investor standpoint, we're looking at a 5x equity multiple, and this is a very conservative multiple, right? So they're like, we didn't want to say 10x because, quite frankly, you probably wouldn't even believe it, right? So we're like, hey, look, let's make it a little more believable, 5x. And the fact that it's conservative means there's a higher chance that, hey, even if they don't hit the 10x equity multiple and they land somewhere at 7 or 6, well, guess what? You still did very, very swimmingly, right? So 50K investment, 5x equity multiple, on the exit, you're looking at 250K, right? 100K, to 500K. So $1 in to $5 out, as my man Sam said. Now, we said it's similar to a multifamily deal in that, hey, small amount of cash flow, and then a big jump at the end. Well, look at the cash flow. The average cash flow is 25 to 35%. Like if you get that rate of return on a multifamily deal, to get 25% IRR or even a average annual return is quite difficult. Now, this is just the cash flow, right? That's very compelling, 25 to 35%. And the reason that we can give these high cash flows is because you're buying existing profitable businesses, right? That's right. We don't have to wait to renovate units and, get a $200 rent premium. And hey, we renovated 12 units. Now, it went up by, those are nominal gains. Here, there's huge amounts of upside because you're buying for much lower equity multiples, right? On the buy. So 25 to 35% cash flow, $100,000 investment, you're getting between $25,000 and $35,000 a year of cash flow. Now, how long do investors, you expect investors to have to wait before these cash flows begin?
Roughly 6 months.
6 months, right? So
roughly
within 6 months.
And yeah, we just want to make sure that things are stable. I think something we see here is that the account receivable times can be a bit wider than real estate, right? It's not monthly, right? We may collect cash for 2, 3, 4 months based on project size. So we just make sure we always have stability in our operating account, but not from a lack of profitability, more so from kind of holding on to cash to make sure the operational piece of it is totally dialed in.
No, that makes a lot of sense. So 6 months, we'll start the cash flow, which is absolutely incredible. Average annual return 70 to 80%. And this is again conservative. It starts to just get silly. It sounds silly. 35 to 45% IRR. Comparing that to multifamily again. Quickly to just look at the cash flow from the investment. $50,000 investment. Year one, $7,500, right? Year two, $12,500. This on a $50,000 investment. By year 3, you're making 30%, 35%, 35%. So the cash flow is extremely compelling. And then you look at the total return, right? This is on a $50,000 investment. You have a total return of 185. And again, very, very conservatively underwritten. Investor returns, now the pref, right? Very high pref. Right? In multifamily, we're seeing 5 to 6, 7, maybe 8% pref. Well, even at 8% pref, this is 30% higher, right? So very, very compelling returns. So this is the reason that, and you can see the merits of the deal. This is why I was so excited to bring this to our group. And when we brought this to our group, only one business had been acquired, right? Now this is 6 weeks later, right? Now they're about to close next week, right? Next week you're closing on the second business. Business, huge business, which has tremendous upside because there's another business within the business with the materials where they've landed a huge 8-figure contract. This only bodes well for investors. I know you shared this with me. I wanted to share this with the group. Like, hey, look, the progression, the people that they've added as advisory roles. It's just a lot of little things that keep adding up, that are building momentum and building the excitement I have from an investor perspective about this opportunity. And that's why I wanted to kind of bring you on here today, Sam. I wanted to actually do this live so that, a lot of the guys that were investing in this deal, they had signed up to watch this. And then a lot of people that were probably just interested in investing and maybe just needed a little bit more information to kind of move forward. They can't ask the questions live, but I will request of you, Sam, that, hey, look, if you guys do have questions, please do put them in the chat. Sam is a part of our community, and he'll be able to answer those questions in the chat.
Yep, of course.
As well as I. Yeah. So, all right, Sam. I don't know. Is there anything else that you want to add before we land the plane here? I think that we got a lot of good information, answered a lot of questions. Especially from my side as an investor, as a fund manager. somebody that wants to see their investors do really well, have good diversity, have access to excellent opportunity. That's what really our group is about. Being able to not only find great opportunities, but also, look at the merits of the deal, right? Doing the due diligence on the deal, the sponsors itself. Again, this is a deal that it's not just myself. I think there's at least 6 other fund managers from our group alone that are involved, plus what other fund managers. I'm sure you guys have some other fund managers as well working on this. So this is a deal that has been vetted, and has acceptance by multiple fund managers, which also adds to my confidence, right? When I see people that I know and trust their judgments as investors, when they are also excited about this deal, this only adds to my resolve, right? That this is looks like a very exciting opportunity. Sam, so I want to thank you one more time, for taking the time to be here. I thank you for your patience because we had a late getting started. Is there anything else you want to add before we kind of sign off? If people want to, reach out to you directly, ask you questions, what's the best way to do so?
Yeah, my email is sam@silvermancapital.co, and Johnny can send that out as well. But yeah, I think the biggest thing here is that this industry right now is really ripe in terms of it's very fragmented, right? We're seeing a huge level of demand for this, right? Think to the, all the roads in the US are graded about a C. There's huge dollars from the Bipartisan Act. This can't be replaced by AI. We're buying cash flowing businesses that have been around for 20 years, right? So very, very stable, and a huge private equity interest to go buy portfolios like this that have already been stabilized for people like ourselves. Awesome.
All right, guys, if you're interested in this deal, there is still some space left. I think we only have about a week and a half, 10 days left. If you are interested, you have to move forward. We're going to be closing this first tranche in about 10 days from now. If you do have questions, reach out directly. If you want to schedule a call with me, more than happy to do so. If you are interested in moving forward on this deal, we have a little bit of space left. You should be able to see in the comments below, you should see the link to our fund. If you've already created an account, great. You just go on, click on the Pave. It's the only active offering in our fund currently. So you shouldn't have too much trouble to find it. You'll find a lot more information about the deal itself. And if you haven't done it yet, all you have to do is go to that link, create just have to put your name and an email address in order to create an account that'll allow you to view the deal. If you want to move forward, you're going to have to fully register as an investor within the fund. That's some process you only have to do once. After you've done that, you can have access to all of our deals with simple just signing of a deal disclosures for each individual deal. So again, the link for that is in the description, in the comments below. Click on that. If you're interested in moving forward, please click on the soft commit button ASAP, so that way we can put you in. Try to accommodate everybody in this first tranche. That's what we're trying to do. We're trying to get anybody that's interested into this deal. This is the last deal of the year. If you want a Christmas gift for yourself, for your family, I think this is absolutely a great gift that you can give to yourself, your future self, and as well as your family and legacy. All right, with that, I'm going to land the plane here and let you know that I want to end with a quote by the late and great Jerry Springer. Until next week, I want everyone to take care of yourself and each other. I'm Dr. Joey Walker.